Welcome back to the Market Manual. In today's video, we'll be looking at the risk management. Disclaimer: this content is for educational purposes only. I am not a financial advisor. Trading carries risk, and past performance does not guarantee future results. If you're looking for a reliable broker, check out my partner link with XNS below. And for traders aiming to scale up with funded accounts, my program Equity Edge is here to help you take your trading to the next level. Now let's dive into today's business. Today we'll be looking at risk management, as I said. Risk management basically is determining the amount of money you're willing to lose in the market. And in risk management, we have two things, which is risk versus reward. And this basically is what you're willing to lose. Compared to your profit. This is what you're willing to lose compared to your profit or reward. And the second thing we have is risk percentage. With risk percentage, this is the percentage you're willing to lose per trade. Basically, you can be willing to lose 1%, 2%, 5%, whatever amount. And this depends on the kind of trader you are. As we know that traders are different and our risk appetite is different. So it depends. The amount, the percentage you are willing to lose is dependent on the type of trader you are and your risk appetite. However, industry standard is don't risk more than 2% per trade. However, some traders are willing to risk 5% per trade. Some are willing to risk 5% per trade. Industry standard is 2%. So this percentage helps in making sure that the amount of money you're losing is a fixed amount or a fixed percentage. There is a fixed amount or fixed percentage. Other than losing different amounts. For example, imagine if you have a trade. You have trades. Let's say the first trade you lose 5 USD. Second trade, you lose 8 USD. Another trade, you lose 20 USD. Then following trade, you lose maybe 15 USD. Other than losing, for example, 8 USD in all these 4 trades that you've taken. On the above example, if you can calculate, you can see that you lost 5 plus 8 plus 20 plus 15. You've lost $48 on the above example. On the second example, times the 4, you've only lost $32 USD. You see the difference there. So risk percentage helps with that. It helps you make sure that the amount of money that you're losing is fixed or it is the same percentage. So RR risk to work. This helps in making sure that we are profit. This helps in making sure that you become a profitable trader. For example, helps with profitability. Helps with profitability. It helps with profitability. It helps with profitability. And also, for example, let's say we have 1 is to 2 RR. That means for every percent, let's say we're risking 1%. For every 1% we're risking, we are going to make 2%. See? So let's say in a week we have we have 10 trades. In those 10 trades, we have 6 losses, 6 losses and 4 wins. In those 10 trades, we have 6 losses and 4 wins. If we're losing 1% per trade, it means in our 6 losses, we have negative 6 R, and in our 4 wins with the 1:2, we have 2, 4, 6, 8. We have 8 R. We have gained 8 R. We have lost 6 R and gained 8 R, leaving us with a net R of 2 R, meaning that in 10 trades, in 10 trades we are up 2%. We are up 2% for the week. We are up 2% for the week, which is a good R, a very, very good R for us. And if that 2% was maybe 1,000, if the amount of money we're risking is 1%, means we have 2,000, we're up $2,000 for the week. So basically, risk management involves these things, which is risk to reward, risk percentage, and also understanding the maths behind risk to between risk to reward, which is RR. So that's it from us, guys. Till next time, please don't forget to like, subscribe, and leave a comment. And also, if you're looking for a reliable broker, please use the link on my bio. If you're looking for a reliable prop firm, use the link on my bio. It helps us pay the bills. Till next time, bye.